Hello, everybody. Welcome to this webinar. It's super exciting to see everybody here. Today, we're going to be talking about closing institutional LPs. If this is your first time joining one of our VC Lab webinar series, um, my name is Mike Supervici. I'm the head of acceleration here at Desal Group. Desal Group is a company whose entire purpose is to help new and emerging managers thrive, to help folks really build enduring venture capital firms. And we do that in a variety of different ways. One of the ways that we do that is through our VC Lab Accelerator, which has helped 470 something firms at this point, maybe 480 firms launch. So we've got a lot of experience sort of seeing the entire process end to end. We have a robust set of tools called Desal Hub. It sort of integrates the entire stack end to end. And for those of you that were maybe on a webinar with me last week, we covered that. Another way we do this is through our Desal partners back office operations. And then finally, last but not least, we also have a fund of funds that invests in emerging managers. And what I wanted to do today is sort of condense all that experience and help folks really get ahead of institutional due diligence and what that is, and as well as how to close institutional LPs. Because as you're sort of scaling your fund, especially once you've gone past the first, second, or third close, especially in a fund one or fund two, you're going to be targeting a lot of these folks. And since I've been sort of on the receiving end of having to manage a lot of these diligence, I'm often on reference lists and things like that for certainly the partner firms that we work with. And we also have a fund of funds, so we're an institutional LP itself. I'm able to sort of provide you this sort of 360-degree context on this whole entire process. So hopefully you're going to find this session that we're having today useful. Couple ways to interact with us. Please, you can introduce yourself into the chat. There's a chat on the right-hand side of the screen. You can say your name, you can say your fund, whatever, but do not talk about your thesis. This is a public webinar, and by mentioning your thesis in a chat like this, it could be potentially general solicitation. So just say, hi, my name is so-and-so. You can put your LinkedIn, that's fine. That's exactly what this is all about. So, just wanted to sort of put that out there, and make sure that you can do that. If you have questions for me as we get farther along into this presentation, there's a Q&A button at the bottom of your screen. There's a Q&A button at the bottom of your screen, and there you can go ahead and add questions. People can upvote them. You can use the little emoji to do that, and I'm more than happy to go through that. I'm going to spend about 20, maybe 30 minutes max going over a presentation about this entire process of closing institutional LPs. Then when we're through with that, I'm going to get off the deck off the screen here and open it up for questions for you, because I'm sure you'll have quite a lot, or hopefully you'll have quite a lot after we get through this. Okay, so let me go ahead and do that here. Awesome. So here is the presentation. So let's go ahead and get going and get started on this. Okay, so again, topic of today is we want to talk about closing institutional LPs. Really quick for folks, what is institutional LPs? As always in venture, there's it's one of my pet peeves and a lot of frustration. There's just like a lot of terminology that's sort of interchangeably used. Like, a lot of times new managers call themselves emerging managers and things like that. And it's just that's another example where it's kind of off. But, institutional LPs, for the sake of this conversations, are corporations, endowments, pension funds, sovereign wealth funds. They can also be fund of funds, right? These are like super professional investors that are investing in funds. Okay, super professional. Okay, there's no, they're very, very like kind of like legit operations as you go through this entire process, and that's what we're going to be talking about today. Okay, and what we're going to talk about today is how to sort of fundraise from these folks. But if you sort of like check out and you're like, whatever, if there's one thing I want you to sort of remember from this presentation is that, look, this type of LP, at the end of the day, they want you to do what you say you will do. They want you to do what you say you will do. This is super important for institutional LP fundraising. It's a little bit different with family office. It's a little bit different with high net worth individuals. You're going to hear me say this a lot, and hopefully I burn this in your mind. But to be successful in fundraising from institutional LPs, you need to be you need to be predictable and perform well. So like, institutional LP fundraising thrives on predictability and performance. It's not enough for you just to perform well. Okay. You need to also be super predictable in your approach. Okay. So let's go through this process. So as you go into a fundraising process from an institutional LP with an institutional LP or a set of institutional LPs, let's just start from like first principles. Okay. um, you're building extremely long-term relationships. If one of these investors decides to invest with you, they're likely going to be investing in every single fund you do from here on out. Okay. And so naturally, if they're going to make that kind of commitment to you, they're going to have to go pretty deep into diligencing you and making sure that you're sort of going to be able to manage their money really, really well over multiple funds from here on out, right? So that you're likely going into a situation where you might be building this relationship with these people for 20 something years. Okay. It's like a super long-term potential relationship once they say yes, right? And so, you kind of want to go into this, right? In the most sort of like candid, transparent way, right? Because you're building a long-term partnership and they're looking for that. The LPs are looking for that, and you're looking sort of hopefully for that. That's what this is all about, right? They want to see that you're like extremely rigorous at managing their money, like you're like a super professional money manager and you're really, really good. You take really good care. You're going to take really good care of that. So obviously you need to have a very rigorous process to do that, because you're not going to be able to fake it. This isn't like startups where you sort of fake it till you make it. This is like the real deal. And obviously you got to be super professional and throughout this entire process, because again, you're dealing with lots of money for a long time. Okay. So, these are, the key word here is built on trust, right? This is like a very long-term sort of trusted relationship. Okay. And what's important to understand is once you sort of enter a process, these institutional LPs, are like looking at what you've done in the past so that they can sort of try to understand what you've done and you're going to do in the future. And that's why, a lot of times you get these questions is like, why does these institutional LPs take 6 months, a year, sometimes a year and a half before they sort of make an investment in my fund? Well, the reason for that is because they're trying to sort of understand, right? Like, how excellent are you, like operationally? Like, are you going to be able to sort of manage my money for 25, 30 years in the best fiduciary way? Because once I make that sort of commitment to you, it's like, it's the most likely scenarios that I'm going to be making that commitment to you over long periods of time over the period of the fund. Do we have similar expectations, on goals? Do we want to achieve the same goals? Like, for example, in our case, our company's called Decile Group, focused on the top 10%. Clearly we're very performance oriented. Like, we want you to perform extremely well. That is the most important thing. But for other institutional LPs, there may be other goals why they're doing this, right? And in performance, maybe it's the secondary goal, right? And so you got to make sure that they're kind of want to make sure that this expectation alignment is correct, right? And so this is why what's going to happen is that they're going to have multiple calls with you, 6, 7, 8 calls. And in every single one of those calls, they're effectively, for lack of better words, want to make sure that, again, what you're doing exactly what you said you're going to do. And, this is where they can catch you in a lie, for example. Like, if you sort of, misrepresented something and then you came back in the call and then you kind of misrepresented it differently in a second call and a third call, those are all sort of like data points for them to sort of understand if you're effectively going to do what you say you're going to do, right? And before I go off of this slide really quick, taking a step back. So for our fund of funds, okay, we probably have more data or more information on emerging managers than probably anyone at this point. So, we run 4 accelerator cohorts a year. We roughly get about 3,000 applications per cohort. Okay, so we accept roughly about 300 to ish people, maybe 250-ish funds, and maybe 50 of those basically graduate the program or are able to finish the program because the program's really hard, right? So just think about the breadth of information that we have just from that entire admissions through accelerator process, right? The best of those firms, right, end up in what we call decile partners, which is our sort of back office operations, okay? And we run and help run those funds together with these managers. So we're able to sort of see kind of how they're performing. And the best of those end up in sort of diligence from decile capital, right? So by the time a firm gets to like our fund of funds, we have a breadth of information that's really, really substantial compared to pretty much everyone else. And the reason I'm telling you this is because even then, right, our fund of funds, okay, will take, months, okay, in doing these calls with you to ensure that you're going to actually say, you're going to do what you say you're going to do, okay? And, we're asking questions, trying to figure out sort of how you sort of are dealing with various situations, right? We do 20 plus reference checks, okay, per person, right? And and it's still, even for us, right? Even though we have perfect information and we are very confident that you have probably, if not the best, one of the best sort of operations that you have. So we don't even have to do that diligence there, whereas other fund of funds or whatever would have to do that. Even in our case, okay, we're going that deep, right, to sort of understand that you're going to do what you say you're going to do, right? And so I'm trying to give you this context so that you are really well prepared and understand what it is, right? So be super transparent, show that in your process as you go through it. And the final point here, of course, exceptional team, we're betting on the manager. This isn't like a startup where we're betting on a company. Ultimately, it's the manager, right? It's the manager that is doing all the stuff, right? So we're going to be spending a lot of time with you. Okay. Let's unpack this a little bit because, there's, operational excellence is kind of like a high level word and stuff. So let's go deep into this stuff, and I'm going to go even deeper on some of this stuff. So operational excellence, again, we need to believe that you're going to be managing the money really, really well for 20 plus years, okay? And at the very top of all this is this thing called compliance, which is where most emerging managers really kind of mess up, okay? And it's going to become really problematic, by the way, if you're an emerging manager, especially in Delaware here later this year. FinCEN is going to put in a lot more regulations around this concept. And, a lot of managers just simply don't have compliance or don't have an understanding of compliance, right? Because they're like, hey, well, my back office provider did this. Well, compliance is another step beyond your back office. Like, do your wires match your legal agreements? Are you accepting LPs from sanctions countries? That kind of stuff. And when you go into a diligence at the institutional level, they're going to say, show me everything, right? And they're going to have a whole bunch of analysts and they're going to look at this stuff. They're going to be like, oh, what's going on here? Like, these people don't match. What's going on, right? Why do you don't have an audit? Okay, fine. Then I'm going to have to look at every single one of your LPs to sort of understand and make that, because I don't want to be in a fund with an LP that's on the sanctions list. Just making this up, right? I don't want to be in a fund where for lack of better words, it sort of looks like this LP is money laundering because they put money into your account from a bank account that doesn't match the legal agreements. That's super scary, right? And so you need to sort of understand this. Ethics, right? How do you deal with conflicts of interest? How do you manage that? What's sort of your policy? What have you done before? Do you have a limited partner advisory committee to sort of deal with these issues, right? So those are some of the things that people sort of look for, almost like table stakes, by the way. I just want to put that out there as well, right? How do you deal with various governance related issues? How do you manage with risks in your portfolio and stuff like that? Are you like, disclosing that you're about to do this? Did you put your LP's money into like a, money market account or something like this? Like, if so, did you disclose that, right? Like, those are like, those are like things that we sort of want to understand. Like, how do you sort of deal with those like risks, right? Because those are important for us to know. And finally, what other policies do you have? What's your valuation policy look like? How have you been following the valuation policy, right? These are all sort of things that, as you go into a DD process, people are going to go really, really deep on this stuff. And just that in itself, right? That in itself could take months, right? Because they're going to have you disclose all this information. Okay. They're going to go and interview all of your vendors, your back office vendors, whatever, things like that, just to make sure that you sort of have the process and everything sort of set up correctly. Okay. Strategy alignment, right? Again, then this is generally sort of done in parallel for the good ones. The ones that they're not as motivated, they're going to sort of do some of these things sequentially, right? But, kind of at the end of the day, like, are your goals matching what we do? So for example, if we're a corporate, what we're trying to do is we're trying to maybe advance our corporate innovation initiatives. Can you help us do that with your startup, your accelerator, or your fund, or whatever? If I happen to be a bank that's trying to promote more funding for a certain founder archetype, for example, in my local region, what's that look like? Do you have a policy around how you sort of manage and invest in those folks? Or in some cases, some folks want you to deploy that money in a certain place, or in a certain country, or in a certain state, or whatever, right? What does that sort of look like? And you got to make sure that it's the right thing. And for all the GPs on this call right now, look, this is where most issues end up ultimately happening, right? Because there's a lot of like ego, right? And you're like, oh, if I could just have an institutional LP in my fund, that'll be so much better, because I'm going to name drop them and all this other stuff. And then you end up like doing a deal with the devil, right? Because maybe, they wanted you to do something that's sort of out of alignment with what you wanted to do. You agreed to those, and because of that, you performed worse, weren't able to raise another fund. You might not even be able to get a lot of carry or any carry, because they put like very large hurdle rates on your carry and all this other stuff, right? So just my point to you is that this is really, really important, right? And so just remember, you are the prize, okay? LPs are lucky to kind of speak with you, right? So you should be interviewing your LPs just like they're interviewing you, right? They're going to be interviewing you for like a year. You should be interviewing them as well. And if you sense that the strategy of what they're trying to achieve is not right for you, just stop the process. You're not going to kind of get to where you need to get to, because now you're sort of in their process and you can't really control it all that well, right? And final thing here is like around transparency. A lot of people, make a lot of mistakes here. Look, again, institutional fundraising and having really good investor relations with institutional LPs is basically around this process, right? Is, how transparent are you with everything that you do? How predictable are you? What are some of your metrics? Are you providing the right kind of metrics on a regular cadence for us? Are you following your valuation policy? Again, I just want to make sure I'm predictable. I don't want to be at a point where, like, I'm going to be not getting my tax stuff, for example, on time, right? Because that would be hugely important, a huge issue for me. I don't want you to put me in a situation where I have to create additional tax burdens for my LPs, right? Or my folks, because you happen to have taken the money and invested it into like some SPV, which you shouldn't do, by the way. If you're on this call, do not be investing in any SPVs or pass-through entities with your funds, okay? Because that creates a lot of problems for your LPs, right? And how did you deal with this? Like, did you clear this with your LPAC? Okay, fine. If you decided to do something kind of dumb like this, like, did you at least clear this, or did you just make the investment? Okay, now all of now you've really created a lot of compromises for me, right? So this is the kind of stuff that I want to know. Like, I want to know that I'm not going to have any drama with you, right? And so that's why we're going to be looking at like all this kind of stuff, right? We're going to be looking at these kind of reports and things like that as you kind of get ready. So just be ready for all this stuff, right? Because this is what it's going to be like for a while. Okay. So let's talk about how you can basically take this process and really ace institutional DD. And I'm going to talk through several things here as we get going, and then we can wrap and get into questions. So by the way, everyone, if you have questions, there's a Q&A button at the bottom of your screen. I'm not really looking at the chat for this, so put questions into the Q&A, and I'm more than happy to answer any sort of questions that you have, okay? All right, so let's talk about the data room. Like without a data room, you can't even begin a process, okay? Like that's one of the first things that people are gonna ask at this level. So get your stuff in order, okay? Good, solid data rooms for institutional LPs take a long time to build. I'm talking like 100 hours, okay? This is like serious, serious stuff, okay? Um, you know, you need to have, your financials in there. You need to show some reports probably from like fund one or, fund two, whatever you had before that. Obviously, you need to show a model in there because they want to see sort of how you're thinking about a lot of this stuff. All your legal docs and agreements and things like that, they should all have their own folders, right? They're going to be checking those. They're going to want to make sure that there's like alignment on expectations, that kind of stuff. You're probably going to have legal DD coming up, right? If they sort of decide to go farther here. So they're going to really scrutinize you on that. Be super transparent about your portfolio. Like I want to be able to see all of your investments that you've made, right? I need to understand like why you made those investments. So if you're already in like a fund one right now and you've done a first or second or third close, and you're not, for example, doing deal memos on every single deal, like I don't mean deep deal memos, like I'm not going to be able to understand your thinking, and I'm just going to like probably move on and look at another manager, right? That's generally how most of these institutionals think, right? Because again, we're trying to build a relationship over like 20 years. And so, you definitely want to make sure that you have all the information in order from your portfolio updates, things like that. And again, because if you're going out and sort of pitch me with your deck and you said, I got X, whatever number performance, and then I look at your portfolio and I try to add up those numbers and it sort of doesn't add up, that's kind of a red flag, right? I mean, I think you would probably agree that if a startup came to pitch you and, the bank accounts didn't match what they said in their financials, right? Then you'd probably sort of kind of worry about it too, right? Right. On team, right? Like, obviously you want like bios and stuff like that on your team, so they know who you are and things like that. You also want references, okay? Like I said, like even for us with Decile Capital, where we know the GP at a level that most people just don't, we still do 10 to 20 reference checks, okay? Generally 10 are going to be on lists. So these are people that you provide, and the other 10 are going to be people that we're going to find. Okay. And so just make sure that you sort of have that ready as you go into this process. Okay. So this is what you're going to have to compile. And I look, if you want to do this, you're going to have to get ahead of this. And a good data room takes usually up to 100 hours, right, to sort of build right. Just want to put that out there. Okay. Two, compliance, okay? Like if you don't have compliance and this is not something that you've been even thinking about, you will really struggle at the next level. Okay. You will really, really struggle at the next level. And again, if you're in Delaware, compliance is going to become even more of an issue later this year with the new FinCEN regulations. Okay. So you need to have a compliance policy. Okay. You need to have a process for dealing with conflicts of interest, and you're going to have a ton of conflicts of interest generally. As you sort of think through, like, do we follow on? Do we not follow on? Do we do an SPV for follow-ons? That kind of stuff for our LPs. Like, you got to think through this stuff. Do you have an LPAC? This is an LP advisory committee. Like a lot of fund ones don't do this. For us, for like Decile Partners, it's almost like one of the first things we do when we set up a fund. But like, if you're not working with uh, folks that can advise you, a lot of people don't even have this, right? And so you got to make sure that you have like an LP advisory committee, and people are going to diligence that. Have you done like KYC and AML on everybody? On everybody. I see this all the time, where like, well, they're my friends, so I let them invest. And there was like no KYC and AML done, no sanctions checks, like none of this stuff, right? That's unacceptable, like at the next level, right? And what's going to happen is that if you don't clean this up, and let's say you're saying, okay, fine, fund one, I'm going to do this from high net worth individuals, maybe some family offices. I don't have to go to this level of detail, whatever. I'll deal with this in fund two. Okay. Here's what's going to happen in fund two or fund three whenever you're sort of ready to get to this next level LP. Okay. They're going to want to see what you did in fund one. They want to see what you did in fund two, and did you do this? Did you do this stuff? Are people in there? Because it's like, if you didn't do this in fund one, like why would you like do this in fund two? Are you okay? That means to me that you were kind of okay with sort of cutting corners, right? And just something to sort of think about, like, you just not, your past behavior, is might can be interpreted by LPs that you're gonna also become future behavior. Okay. Ops, like how thorough was your process? When you sort of invested in these companies, did you go super thorough? Like, did you do detailed, you know, memos? Did you, identify conflicts? Did you sort of go through a process, or were you just sort of like writing checks? Did you like review the investment agreements against market? Were they redlined by your team, by your whoever's that? Like that kind of stuff is important to institutional LPs because you're sort of showing, hey, I'm going to be putting your money into as safe of a, at least as safe a companies as I can. The main risk that I'm ultimately going to have is whether a company succeed or fail, which is just sort of natural startup risk. But as far as like how we invest, it's going to be like super buttoned up, super legit, right? And so, operations here is really critical as you kind of work through this process and understand it. Okay. Okay. This is another issue, right, Greg? We sort of kind of touched base on this on that first slide about reporting, but like, did you deploy the money correctly? Like a lot of times people in fund ones cut corners. Sometimes, that especially if they're not being like run by decile partners. I've seen situations where, you know, they deployed more money from each LP. Like, for example, they had pre-funded accounts and they invested the entire pre-funded account from an LP into a company. That is terrible. That basically more or less means you're kind of screwed for life with regards to like getting this kind of money, right? Because it shows that you weren't like, you weren't properly taking care of people's money. Once you have a capital call schedule, every LP needs to be on the same capital call schedules, no questions asked. This is the way it works. But some people cut corners because like, I don't have any money, so man, let me just use a little bit of this like pre-funded or whatever. Like, no, like that's bad, that's terrible, right? You're and again, at the institutional level, they're going to say disclose everything, right? And if you see this, and if I see this, I'm going to be like, no, I don't want my money. I don't feel like my money is going to be safe, by putting it in there. Okay. Um, you know, I'm gonna want to see sort of what do your quarterly updates look like. Are they like legit? Am I going to be able to learn something of this? Am I going to be able to manage my business off of like your reports, or are they super high level? I'm not going to be able to learn anything from them, right? And so, people are going to want to see that you sort of have been operating like this. This is why it's so important to be kind of institutional grade from like fund one, and you can't cut corners on fund one, which we see a lot of people do. You got to do it right from the beginning, because if you want to get to this next level, which is the whole point of like launching a fund, right? You want to have multiple funds under management over time. Otherwise, you can't build a business. You ultimately are going to need this type of capital, which is predictable capital, right? It's capital that you're going to sort of be able to rely on for the rest of your career. So you just get bundled up now. Okay. Um, this is another issue we see. A lot of people try to cut corners on this. Like, you got to have a super high-end back office. You just have to have a super high-end back office here. You can't like work with like your cousin or something that understands accounting or something. This is like very specialized style of accounting. And there's an enormous amount of risk for LPs if you don't have that. And again, if you didn't have that in fund one, that's going to create issues in future diligence, right? So, make sure that you have the right type of kind of back office operations to sort of deal with this issue correctly. And the problem that you sort of have right now is that, again, traditional fund admin providers generally just do reporting and filings. They don't work all the way through compliance and legal ops. And so most of the operations that if you were just sort of just hire like a natural sort of back office provider, you might not have everything set up, and then you're going to end up with issues in diligence. So just, make sure you have everything sort of set up there well. Okay. All right. So let's sort of talk about references. But before I do, and if you sort of join late, one of the first things I said before I kind of ran into this like process about how to close the institutional LPs and things like that is, this level LP is going to get to know you for like 6 months to 12, sometimes 18, okay? And they're going to have lots of calls with you. And the reason they're having lots of calls with you is because they want to make sure that you're trustworthy and that you're going to do what you say you're going to do. And they may ask you questions that are going to effectively trying to catch you in a lie, right? And you never want to be caught in a lie, obviously, right? But, maybe you sort of misrepresented something or something like this. They don't want, that means that you might misrepresent things in the future, and then therefore you're sort of unsafe, okay? And so they're going to be doing these calls with you. And then they're going to do reference checks. And the reason they're doing reference checks is to sort of validate what they've sort of learned from this like extensive, like 6 to 12 month, possibly 18-month process that they've had with you. Okay. So they're going to call people like myself or whatever and just say, hey, how did this person perform? Da, 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 and ask me a bunch of like sort of open-ended questions and like have me sort of talk through that so they can feel comfort in understanding that. Right. And they're going to do, as I say, your on list references. So you're going to all have references in your data room. But they're also going to do off-list references. So they're going to find people all the time. We did that for several funds, right? And, very, very important that you sort of do that because you never know what you're going to find out. And those of you that are entrepreneurs, right? And you've hired people, you've probably done some reference checks before, so you probably understand the value of this. Those off-list references, though, provide an enormous amount of value, right? Because we can sort of see kind of how things went when things went well, and also how things went when things didn't go so well. So be ready for that, because what they're sort of doing with this is just confirming, right, what they've sort of learned throughout this entire process with you, and to make sure that it's sort of a good fit. Okay. So look, before I kind of hop in, I see there's questions coming in. Let's just sort of really quickly summarize things. Like first, you really want to be committed to building a VC firm, not a fund. Okay. The economics don't really work that well if you're just going to do one-off funds. Institutional LPs are not going to be comfortable investing in you if you're doing a one-off fund anyways, because they know you're not going to have enough fees to sort of survive in like year 10. So you want to build an institution, okay, like a firm, right? And to maximize the probability that you're going to succeed, it's not enough for you to just perform well. A lot of people think that, oh, I perform well. Look at my track record. I've done so well. Like, like you should just invest in my fund because I've performed well. And at this level, that's not enough. Okay. You're already risky as it is because if you're on this call, you're likely an emerging manager, so you don't have a lot of track record. Okay. Track record at the institutional level. That means DPI in like funds that you've operated. So by definition, for most of you, you don't have track record really for this level until you're like on fund 4. Okay. And so, they're going off of other types of information in hopes that ultimately you're going to become successful. So it's sort of a risky bet. And again, if you're an institutional LP and you make a risky bet and that risky bet doesn't work out well, you're going to get fired, right? And so that also plays a role in sort of how you think about this. So it's not enough for you to perform well. You have to be predictable and perform well at the same time. And so if you want to maximize your opportunity that you're going to close institutional level LPs, you have to have super high-end institutional like vendors. Okay. Like it can't just be like, like this like one law firm and this back office provider. That's generally not enough. Okay. To do really, really well. So just something to think about. Your ops have to be super well integrated, managing conflicts, all these other things. Like if I see that you did like an off thesis deal in your second investment or third investment, that's weird. That was like, why didn't you do why didn't you make that right investment? That kind of thing. Those are like all red flags, right? And I can't stress this enough. Okay. You have to have maximum alignment with your LPs. You're going to be partnering with these organizations for the next 20 something years. Okay. So don't compromise on like your mission because you want to get the money. Okay. Like if an LP has these requirements to say, okay, I want to invest, but I'm only going to invest my money in a certain country or a certain state or whatever, and that's not really what your strategy is. Don't be like, well, maybe we should think about this because generally we do invest in that one country, and so it sort of is aligned like, no, like that's not good enough. Like you have to agree that this is exactly how you want to perform, and no money is worth it. Remember, you're effectively working for them, right? You're going to be hired by these people or by these organizations. Effectively, that's essentially what this is, and so you got to make sure that if you're going to spend this much of your life, that you do something that you like doing, that you can make money doing this, right? That it's worth all the effort, because this is hard, right? This is really hard to manage these types of LPs, and for good reason, right? They put a lot of money to work, so it should be hard. It shouldn't be easy, right? It should be a challenging thing. So just make sure that you have maximum alignment with expectations, and you got to understand that early, because you do not want to have this conversation and understand this 6 months into it, because now you're so deep into this process and you've already invested thousands of hours on this process that it's just going to be so hard for you emotionally to throw everything away. And instead, what you're going to do is like talking to your teams like, well, maybe we can compromise on this like this. Maybe we can compromise on this like this. And I'm telling you, every little compromise that you're doing, you're compromising on your life. Okay. Because this is a 10 or 20-year relationship. So just make sure you have maximum alignment on this. Okay. So I'm going to stop sharing my screen. I see there's quite a lot of questions coming in here into the Q&A. If you have questions, everyone, there's a Q&A button at the bottom of your screen. Make sure that you add them in there and you can sort of upvote them. And then I'll go ahead and get through as many of these questions as I can. All right. What would be transactions, be the transactions of emerging managers, those who are just starting their funds, that LPs deem the most important and want to see? The attractions of emerging managers that look, what they're going to want to see is they're going to want to see like why you made these bets. Okay, like at this level, these people are smart, right? They know that whatever TVPI number you gave them is kind of like not that useful, because you've only been investing for 3 years or whatever it's been if you're on fund 2, right? Or if you're on fund 1, you don't even have that, right? Like, I mean, you do have it, but it's just like, okay, you made some warehouse investments, 5 investments. That's not really track record, right? So what they're going to do instead, right, is that, again, it's like a primarily a pitch bit or a decision to back Ching in your case, right? And so they want to see how professional, why you invest in these companies. Do they believe in these companies that you invested in? That's why they're going to this level, okay? As you get farther along, so let's say that you're on this call, attending this call right now, and you're like on a fund 3 or possibly a fund 4. now your data room is going to be even more robust, and they're going to want to see more stuff. They want to see more metrics on your funds. They're going to want to see DPI typically from portfolio. They want to see how you manage those exits. That's really important because a lot of times there's a lot of drama that happens when you sort of manage those exits. How drama free were those exits? So that's sort of what they're going to be looking at throughout this process. So hopefully that's useful. If you have a follow-up questions, feel free to add them into the Q&A. I see there's another question that just came into the chat. Everyone, we're not answering questions in the chat. There's like a Q&A button at the bottom of your screen. Post it there and sort of upload it, and I'll be more than happy to go ahead and answer your questions. Who are good candidates for the LPAC? Hey, Jamie, good to see you. And how many should be on the LPAC? When you're first getting started, one person is fine, Jamie. It's a limited partner advisory committee, so it should be an LP. Ideally, an LP that you trust and that you have a good working relationship with. Because again, the whole purpose of the LPAC is that it's clearing conflicts of interest, right? And so you want to make sure that you have a person that you trust, and then you have a person that ideally understands venture. Because if the person is an LP but has limited experience with venture capital, now you are forced to explain to them why something happens like this, or why you're doing this like this, like technically from like a technical perspective. And so, just something to sort of kind of keep in mind as you work through this process, because it's pretty complicated, to make a decision on a conflict if you don't understand venture capital. So I would start with one, Jamie. Okay, that's where I would start. Learn how to manage your LPAC, build with your LPAC and things like that. And over time, you're going to add people. It's possible that you may get an LP, and as part of their investment, they may want to be on the LPAC if it's a large enough check. And if it's someone that you trust, maybe you give them that seat, maybe you don't, right? But expand the LPAC accordingly after that, if that makes sense. What kind of documents are you expecting in the research folders, research on past deals or more? It's more like thesis and market, so, if you're going after like mental health or something, you're gonna have some stats and some information about kind of like why mental health is like a huge market or whatever the case may be. So yeah, you're gonna have things like that. You're gonna have, like analysis, reports, anything that you can sort of find, articles, generally like technical ones. And oftentimes it's your research. So what's going to happen for a lot of folks, especially as in Anthony, obviously I know you, right? And you're kind of on fund one right now. But once you get into fund two, fund three, you're going to be doing this kind of stuff almost internally on your own. You're going to do some of your own research. You're going to learn a lot from like your seeing stuff. Like when you get to fund two, fund three, you probably by that point have seen several thousand companies. And in many cases, you are the market. Okay. And so you are able to generate reports. Once you close your fund, you can be a lot more public about fund one, and you're probably going to be publishing some of these reports as well for deal flow and other purposes, right? So a lot of that stuff ends up there as well. Once institutional investors have been landed, what is the best way to leverage to secure other institutions that may be on the fence? In general, that's the context of this question is a little suboptimal. Look, you generally don't want to name drop, okay? Because you have no idea if an LP likes another LP, okay? It is very common that other LPs will pass, okay, on your investment because another LP is involved in. And the reason that that happens is because of all of this stuff I talked about with regards to alignment. So, for example, we're a very performance driven fund of funds, decile, like top 10%. Like it's all about like performance for us. That's almost above all else. If we see that you have an LP in your fund that is investing in your fund for other reasons other than performance. And they're forcing you to do certain things in order to sort of prove that you've, I don't know, let's say that you're like investing in like ESG or something. I'm just making this up. And then they forced you to sort of have some sort of policy around ESG, and then you're kind of investing in a certain company, as type of companies. They put some sort of handcuffs on you that forces you to do that. Well, to me, that says that I might not be able to get the performance that I want to get, right? And so that actually creates a lot of problems for you. So you don't really want to necessarily ever name drop people unless you have to. Now, what's going to happen as you get farther along in DD, it's likely that if the check is big enough, and only if the check is big enough can you sort of accommodate these requests, or you should accommodate it. They're going to like say, hey, who else is involved, right? That's really late in the process, not early in the process. And at that point, you might be able to sort of name drop that these folks are in. But in general, I wouldn't use that strategy. What I would say, though, on a high level is that, when you're going to fill out this DDQ questionnaire, you'll see there's like 30, 40, 50 questions, depending on the DDQ questionnaire. And they're going to say, hey, what's the LP composition of your fund? And that's where you would say, we have several institutional LPs, some family offices, and high net worth individuals. And you keep it like sort of high level like that. Now, you could leverage your institutional LP for references or for, referrals, right? That's a way to kind of handle that, because you sort of know that they've worked together and maybe there's a little bit less risk there. That could be one way you can deal with it, but I wouldn't like go out and market, hey, so-and-so LP invested in our fund. That creates a lot of issues for you. Would LP be interested in solo GP funds? Yeah, they LPs invest in solo GP funds all the time. All the time. So this is not like startups. Okay. It's like you're the owner of the fund. Okay. And so, the risk is actually existential if you have two owners of the funds that break up. It's not like startups where you have these like nice vesting schedules and like these like conditions to help founders exit, co-founders exit. No, you're like owners, and you're like, remember, they're investing in you to manage their money for 20 years, right? And so they're like, it's a pure bet on the person versus a pure bet on like a startup with like infrastructure and like company, and then you can promote that person or whatever to kind of fill that gap. No, right? And so oftentimes, a solo GP bet is sometimes less risky, right? It's certainly less risky than if people didn't know each other for years and years before that. And so one of the things that you'll see if you're a team pitching institutional LPs, they're going to spend an enormous amount of time kind of diligencing both GPs and their relationship. How do they know each other? What happened when this thing went south? What happened with this project? What happened with this other project? That kind of thing, right? Because they're going to want to do that. So sometimes solo GPs have an edge there. Not always, but sometimes. For emerging managers raising their first fund, is it true that for funds of funds and family office are the best ones to try to close, or that would depend on the thesis? Again, if you're raising a first fund, you're not an emerging manager. Okay, you're a new manager, and you have like a scarlet letter on your forehead that says, don't fund me. Okay, and I'm trying to be a little dramatic here, but I'm trying to help you understand so that you can focus on the right LPs. Most fund of funds do not invest in new managers. Most family offices generally don't invest, especially the big ones, don't invest in new managers. Most of the institutional LPs that we talked about here don't invest in new managers, okay? It's just too risky. You've never done this before, right? And so they're like, how do I believe that you're going to manage my money really well for like 30 years or 20 years if you've never done this before? So you're going to primarily be raising money from high net worth individuals and some really, really small family offices that sort of act almost like kind of high net worth individuals plus. And in some cases, there's going to be some like, kind of a fund of funds that are specializing in new managers like ours, or folks that are trying to like promote a certain thing, like they're kind of trying to, back to the example I use, want to invest in ESG. Sometimes they make some compromises there, but most of the time you're going to be raising money from high net worth individuals and some small family offices. How can we find out what the min-max ticket size of certain individual investors are? They'll tell you, they'll generally tell you during the process. That's why, again, you should be asking people for this kind of stuff. What are the best platforms to source LPs? None. Okay, none. Platforms don't work for sourcing LPs. Again, this isn't like startups where you can kind of go on like NFX and find like who all the seed investors are. You're going to be raising money primarily through relationships that you have. And if you don't have a network right now, Bradley, you will struggle to raise money. So what I would do is just continue to build out your network. And there's a lot of issues with this right now because obviously this is brutally difficult. And so a lot of people are like trying to say, hey, just come to my thing, come to my program, and you'll meet all of these LPs. And again, the KPI for you is not meeting LPs. The KPI for you is money in the bank. Okay. And, you may go to something or you may go to some program and you may meet some LPs, but if those LPs are super mistargeted, so for example, if you're on a fund one and all you're doing is meeting institutional LPs, ain't none of them going to fund you anyway. So it's a complete waste of your time. Right. And so, a lot of like this fundraising with LPs, it's sort of GP thesis LP market fit. Okay, like this is why I spent so much time in this presentation talking about alignment of expectations. Okay, so your job is to find the right LPs that make the most sense for you, and you're going to find those primarily through your own LPs, through your own connections, through your own network, and things like that. And be super, super, super wary when you hear about platforms, programs, anything like this that says I'm going to introduce you to LPs, because those generally don't work. Because again, the KPI is commitments. It's not meetings, it's commitments. Okay. All right. Lots of questions coming in now that we're almost over. So everyone, please go ahead and upvote some questions so that I can kind of prioritize here. Question from Grace, given the fact that most institutional LPs de-risk by investing mostly in managers and fund two, is there a specific case where they invest in first-time managers? Again, they do sometimes if they are very specialized in investing in new managers, like for example, that's what we do. They also do sometimes if they have a certain initiative that they're trying to meet. So for example, I don't know, you'll see more compromises being made, for example, for LPs that have certain like diversity initiatives or environmental initiatives, or trying to promote the economy in their local ecosystem initiatives. So you'll see some of that stuff happening. But if, I flip it and I say, how can you build an enduring VC firm? You just don't worry about the institutionals, right? I would do a small fund one, build it with high net worth individuals and some small family offices, use that to generate enough track record and get to fund two as quickly as possible, right? In a year and a half, now you're in fund two. Now you can go out and unlock these people versus trying to say, what can I do in fund one to attract these people? I wouldn't do it this way, right? I would sort of build my strategy around the conditions on the field rather than trying to find, additional ways to sort of deal with this. How big should the LPAC be, or is it more focused on funds thesis? I think you got to start with like one person. Learn your way, learn how to deal with this, and it should be one LP. Then, once you get through that, I would go to more people. Regarding off-list references, everyone has past relationships that didn't work out. When you find one of these in an off-list, what kind of weight is that? Is there anything that GP can do to mitigate? I mean, not really. Like if you're doing, if you're good at what you do, in other words, if you're an LP that understands this and is good at what they do, they're gonna they're still, they're gonna factor that, but they still might make the investment, you know, I mean, we dealt with that before and we still made investments. And so it's not, the end of the world, and you're a human being, right? And so it's okay for there to be, for it to be sort of fair and balanced and not just one way, you know? Now, you know, if you did something really bad, right? Like, you know, like that, there are cause for ethical concerns, then hell yeah, it's gonna be a problem, right? Because it's ethics, right? And, you know, I'm expecting you to manage my money for 20 years, right? So of course, that could be a problem, you know, but otherwise, it is what it is, and I wouldn't worry about it. Uh, are there any conferences that you could recommend for raising money as an emerging managers from the US or European institutional investors? We did list a list, we have a list of events on our website for this stuff where you can meet some people, and I would start there. So just go to govclab.com and you know, just do that and start that process and look there, because we kind of listed all the sort of events that you kind of want to look at. They're hit and miss, you know, you kind of want to go there with a deliberate agenda is what I would say. Oh, look, it was posted in the chat. All right, final question here before we wrap. When engaging with a bank, what are the tactics to engage the fund into being able to commit capital on the raise? I don't know what this question means, man. You know, uh, I think, you know, the way, again, we're talking about VCs here, like banks rarely sort of invest in VCs because they're super risky, just FYI. There's some that do, like SVB used to do that before things kind of went south for them. But as a general rule, they don't. They're kind of too risk averse for this. What you want to make sure that you have is a really good relationship with your bank, and you want to make sure that you're super proactive in your approach with the bank, you know, and make sure that, you know, if the bank says no to you, that you don't push them too hard, right? Because that's, again, going to lead a trail, and it's going to end up in DD somehow, right? Especially at the next level. So you just got to make sure that those relationships are managed really well. All right, everyone. Hopefully this was helpful. Hopefully you've learned a little bit. You know, as always, we do these events pretty much on a weekly basis. And so feel free to subscribe. You know, looking forward to maybe seeing you in one of our programs, or you know, one of our events. See you. Bye, everyone.